Yesterday, we warned that U.S. consumers at a breaking point as they quit paying on their car loans at the fastest rate since 2009. And today, we have new evidence that is spreading all across the U.S. economy as we're finding out that spending just stopped. And tonight's show is brought to you by Monetary Metals. If you're interested in earning a yield in gold, paid in gold, check out the links in the pinned comment or description below. Now let's turn to Bloomberg because I want you to see how the mainstream media is spinning this. They want you to think that the U.S. consumer is strong and robust, but I'm going to show you why that the retail sales report today is completely misleading. As U.S. retail sales surge in a broad advance, topping estimates, but there's one major problem with the retail sales report that puts that headline number into question, and that is not inflation adjusted, and that's a major problem. Because the value of retail purchases, not adjusted for inflation, increased 0.6% after declines in the prior 2 months. And that exceeded nearly all estimates because based on what we're seeing in the economy, we're seeing it continue to slow down. And relative to inflation, what we're seeing with consumer paychecks is they're continuing to shrink. And when we look at a lot of the surveys, we're finding out from workers they're worried about their jobs, they're worried about their incomes, and that puts into question this headline number because as you're about to see, there's mounting evidence that not only has spending stopped, it's about to completely collapse. And Thursday's report offers some relief amid mounting anxiety around the health of the consumer. Americans have been largely pessimistic on the economy and their finances this year as tariffs threaten to worsen a years-long cost of living crunch, though sentiment has rebounded somewhat recently, likely tied to the fact that the stock market has gone up. But the anxiety that consumers are feeling has nothing specifically to do with prices going up, has everything to do with their paychecks. Because if paychecks were rising, particularly at a faster rate than inflation is, then it wouldn't be an issue. The problem here has everything to do with the labor market, and we just got some evidence earlier this month that shows that paychecks are shrinking in a rapid way, and that's why we're seeing spending grind to a halt. Let's take a look at the University of Michigan Consumer Sentiment Survey in blue against average weekly hours of production and non-supervisory employees. And you can see the very clear link between hours worked and sentiment, because as hours worked go down, that means paychecks shrink and the outlook for a consumer's finances go right along with it. And what we're seeing here is we saw that big drop in sentiment. And I had said, I wonder if this is something to do with paychecks that hasn't shown up in the data. And then sure enough, we got the non-farm payroll report, and what do we find out? That average weekly hours for production of non-supervisory employees has now dropped to the second lowest period since the pandemic. And so we know at a time when price pressure is still there, paychecks are shrinking in a big way. And this is a problem for the retail sales report because they want you to believe on the headline that things are better and the consumers are out spending. But when you start looking at the details, maybe it's not so clear that that's really what's happening. Spending at restaurants and bars, the only service sector category in the retail report, advanced 0.6%. But there may be a really good reason for that, because when we've looked at data from the travel industry, what have we been hearing about? Too much capacity and not much demand as consumers pull back on their travel spending. Maybe they're staying at home and going out to restaurants and bars. That could be a good indication of why that number jumped. But because Thursday's figures aren't adjusted for inflation, a decline could reflect less spending activity. There you have some evidence that perhaps spending has stopped, or simply lower prices. Now, we know prices really haven't gone down that much. There are cases they have, but not broadly speaking. And certainly an increase could indicate higher prices rather than more sales volumes. And that means, of course, what we're seeing across the economy now is spending has stopped. And when you start taking into account that hours worked have dropped and are likely to drop even more, I've got some evidence that will show that later in the show. What it's telling us is spending is likely to collapse. Owning gold is often talked about during times of economic uncertainty. While some choose to hold gold to diversify their assets, there are other options to make your gold potentially more productive. Monetary Metals presents an opportunity to turn your idle gold into a productive, yield-bearing asset with the potential to pay you more ounces of physical gold every month. The income is earned in gold, not dollars, not IOUs, but actual physical gold deposited into the account every month. The approach allows gold owners to potentially generate yield while retaining ownership. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com Stephen. The risk to any investment. Risks of leasing gold include but are not limited to loss of gold principal from leasing to monetary metals and other counterparties, shipping, or any other time gold is in transit. If you purchase gold through monetary metals, you may pay up to 0.75% over spot price. Additionally, the price of gold may experience a substantial loss without assurance of rebounding. This is not a recommendation. Before making any investment decision, it's crucial you conduct through research, understand the terms of participation, and assess potential risk. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. Let's take a look at advanced retail sales. This is now adjusted for inflation in blue, and it's just hovering right above the horizontal black line. And let's overlay again average weekly hours of production of non-supervisory employees in red. And what do you see? A very good relationship. As paychecks start to go down, spending goes down right alongside with it. And we can look at the mid-90s and the early 2000s, and we can see they're pretty much right in sync. Now, that didn't happen going into the global financial crisis, because what you can see is hours stagnated, but at the same time, inflation was rising, and that meant, of course, retail sales, discretionary spending, all moved to the downside. When hours work dropped off, you can see spending dropped off as well. And then in 2021, we start to see the same effect, hours going down, retail sales going down, and now we're seeing, again, hours at the second lowest level since the pandemic. What is that telling us? That U.S. consumers, they're going to see their spending power evaporated. That means spending is not just going to stop, it's going to outright collapse. And a separate report out Thursday showed import prices barely rose in June after declining a month earlier. And this is a very clear sign that demand is going down. And this is a major risk for the economy, because we've been seeing a lot of inventory building, a lot of front running of the tariffs. And we have warned that for a lot of businesses, they're using up their cash, they're borrowing money, and they're building these inventories. And if they can't spend it, what we could see is disinflation, perhaps even deflation in parts of the economy. And based on what we're now seeing with consumer spending habits and retail sales, it's warning that we're facing perhaps an inventory bubble on top of the payback period that's coming not just from the pandemic, from front running the tariffs as well. But something that should be surging higher, that is your trading account. Check out this trade we put back on the 10th for our Momentum Timer Pro subscribers on ETHE, that's Ethereum. That trade now up 21.25% as of the close of business yesterday. Now, for all our subscribers, whether the CTA, the Trades Against Machines, or our Momentum Timer Pro subscribers, we have now done something incredible. We are putting in more and more signals to our reports at absolutely no charge. If you haven't gotten in on this, or maybe you're a former subscriber and thinking about coming back, now's your time. Grab those links in the description below. Use your coupon code for your free 30-day trial, because we're changing the way people trade in a big way. But let's talk about import prices and consumer behavior, because what all this is indicating is demand is going down. Let's take a look at the consumer price index in blue, overlaid against the import price index in red. And you can see throughout history, when you have collapses in import prices, what that means is consumer prices, now this is going to happen with a lag, are going to trend down. So everyone's worried about higher prices. You're going to hear that from the Fed at the end of the month, that they're still worried that inflation is going to create a massive price shock. But based on what you're seeing in the retail sales data, based on what you're seeing in hours worked and import prices, what it's telling us very clearly is inflation is coming down. And there's some other evidence here that the consumers are at a breaking point, and that things are going to get worse for retail sales. I'm making the case here again, spending not only stopped, but it's going to collapse. Let's turn to the Philly Fed, who has a report on the bank credit card and mortgage data, and they note in their latest report that credit card performance showed signs of improvement in the first quarter, with all measures of delinquency declining year over year. But hang tight, it hasn't declined very much. I'm going to show you the charts here and what this means for sales going forward. This marks the first annual decrease across all delinquency metrics since the fourth quarter of 2021, which have been heading higher. But here's the reason why. Tightened underwriting criteria have led to a net decrease in total credit card accounts and balances, as well as a recovery in credit performance over the last year. And this is a key point, because what you're seeing here is banks are tightening lending standards, so they're not issuing as much credit. So what happens in those periods? What you see is consumers start to cut back on their spending and start to pay down on their cards, because they know they can't get more credit, and they're worried they might need it at some point. So the fact that delinquencies have gone down a little bit here, well, they're going to go up and a whole lot more, particularly based on when you see that big decline in hours worked. Meanwhile, net charge-offs, that's by the banks, and delinquency rates remain elevated compared with pre-pandemic levels. Even worse, at the second highest level in history since the Philly Fed started tracking data. Let's take a look at this chart here of delinquencies and net charge-off rates, because you note charge-off rates are at all-time highs based on this report going back to 2012. Now, they're noting that 30, 60, and 90-day delinquencies have dipped a little bit, but they're right off the highest level they've ever been in history. So this is a major risk here. You can see signs of stress in the delinquency space. And what this means is, of course, as consumers rack up delinquencies, their credit goes away. They can't spend money. Remember, the hallmark of the U.S. economy is that U.S. consumers buy things they don't need with money they don't have. When they can't access money they don't have, they can't buy things they don't need. And that's why you see this chart here as we start to look at what's really going on at the banking sector here is they're tightening standards. Now, in blue, you see the net percentage of banks tightening standards for commercial and industrial loans, but you can broadly apply this across all loan types. And we're going to overlay the delinquency rate on credit cards so you can see exactly what the Philly Fed's reported here. As banks tighten lending standards, you see delinquency rates go up, because what's happening here is banks see the economy slowing down. And if you've ever lent money, you understand this relationship very clearly, is you want to get your money back. And that's exactly what the banks want to do here. So they don't want to extend more credit because they're afraid they're not even going to get the money they've lent out back, let alone even more. So they tighten lending standards, and what happens, that curtails the creation of credit. In a debt-based economy, it starts to slow things down. But for the banks, it means the pain is going to get even worse, as well as for retailers. And you can see every time the banks tighten lending standards, the delinquency rate goes up, and the economy, well, goes right into recession. Now, we didn't have that happen in late 2023 and early 24, but the risk now is, as banks tighten lending standards even further, the delinquency rate's going to go up. And what that means for real retail sales is they're going to go down. And again, keep in mind, this is a time we have massive inventory overhangs from front running the tariffs. And you can see very clearly here that retailers are going to face a major problem. That is, consumers are going to stop spending. And here's the clear evidence. As the delinquency rate goes up, real retail sales go down. And you can see that in every cycle. And that's exactly what we're facing now. And you can think back, it's everything to do with the banks. They tighten lending standards. They curtail the creation of credit. And remember, new money is created when the commercial banks lend. As they curtail the creation of credit, there's less money in the economy. And now all of a sudden, you find out that money has to go to pay on debts. There's less money for growth. And it all of a sudden leads to a broad slowdown in the economy. So what we're seeing here at the consumer level, the reason they're not paying on their car loans, the reason they're still in delinquency on their credit cards, and why this is going to get worse has everything to do with the banks. And the problem is, for retailers, it means the pain is going to get even worse. Now, the problem is it's going to spill over to the labor market, but at least for now, we haven't seen that get any worse. As U.S. initial jobless claims decline for the 5th straight week. And keep in mind, this is because a lot of employers want to hang on to their employees, and we understand that. They've mentioned that. And now that the tax package is passed, our expectation will be, at least for the weeks to come, unless something in the economy all of a sudden gets much worse, they're going to hang on to employees for a while. And if things don't turn around, watch, you're going to see them start to lay off again. But the real risk isn't in initial claims, it's in continuing claims. But first, let's check this out. We see initial claims decrease 7,000 to 221, but continued claims were very little change at 1.96 million, and that's a major problem because we have long-term unemployment here. And again, think back, when more people are on unemployment and they're on it for a longer period of time, their spending goes down more and more. And again, you start to see that hit the retail sales numbers. And what happens? We've seen this coming out of Texas. What did they tell us? That they had to cut hours in the retail space. And all this is a response to is a lack of demand. So as hours continue to go down, spending continues to fall, next thing you know, you find more and more people hit the unemployment line. But when we get into the details of the report, we find out New York, Nevada, and Texas saw the largest unadjusted increases. And you may remember yesterday I was warning about rig counts. And I said that as we continue to see rig counts decline, the demand for labor is going to go with it. That is probably a major red flag in what we're seeing in Texas right now. And the signs are it's only going to get worse. But let's turn back to Philadelphia, because there are some warning signs in the manufacturing sector there that for U.S. consumers, the pain is going to get even worse. As general activity returned to positive territory and the indices for new orders and shipments both increased this month. In fact, all three indices recorded their highest readings since February, and that is a great sign for the manufacturing sector until you start to realize a lot of this is front-running the tariffs. Now, keep in mind, we know this is supposed to go in place somewhere around August 1st. Maybe there's going to be some delays, but broadly speaking, a lot of manufacturers and a lot of consumers now understand that the tariffs are going to be set sometime in August. Now, the firms reported overall increases in employment as they looked to get through some of this production. But here is the red flag. The average work week index only inched up to 0.4. So that means, broadly speaking, there were more people hired, which is great news. But those who did have a job didn't really see more hours. They didn't see their paychecks really go up. And that's a problem because, again, you think back to how many Americans are behind on their car payments and their credit card payments. And what could they really use right now is a lot more hours. Give them an opportunity to potentially catch up here. So what you can sense from the manufacturing sector is they're bringing on a lot of part-time people, and they know that they can cut if they need to. But here's another risk for the economy. The prices paid index rose 17 points from 41.4 to 58.8. The current prices received index increased 5 points to 34.8. So there's two issues here. One, we're likely to see rising prices get pushed down to consumers at some point. But the bigger issue here is they are pushing across some of these price increases, but they're not getting as much. So that means a lot of manufacturers are taking a hit at the margin. And at some point, as the economy continues to slow down, we know what that means. They're going to lay off all those workers they just brought on. They're going to cut hours because at some point they're going to defend their margin. And again, this is a major risk for the economy because workers already know this. And that's one of the reasons why you can see now they've stopped spending. But when we look at the plans for wage and compensation increase, we can see 69% of firms report having made no changes, but 28%, a mere one-third, indicated they plan to increase wages and compensation. So more and more employers who are getting squeezed at the margin are starting to cut back on wage growth. They're only adding employees when they need to. They're only giving out hours if they have to. And this is a major problem because if the economy continues to cool off, despite the passage of the tax bill, which helped a lot of small businesses and a lot of employers, it's not going to last for long because right now the issue is demand is plunging faster. It means we're facing a dollar shortage. There isn't enough money to power the economy, and the evidence is clear. As tariff risk has nudged more firms closer to default, this according to Moody's, and we're going to see more and more headlines like this in the months to come if the economy doesn't turn around. And based on what we're seeing, there's little evidence to support that it is going to change because when consumers stop spending, it doesn't matter what else happens in the economy, it means we're doomed. And the number of companies at the greatest risk of defaulting are at an 11-month high as uncertainty around U.S. trade and tariffs worsen credit conditions. In the second quarter, 16 companies were added to the cohort of businesses with the highest default risk. The group now stands at 241 companies. And what we know is, again, as consumers cut their spending, that default list is going to go higher. We know credit card delinquencies are going to rise. We know car loan delinquencies are going to rise. And at some point, we're going to hit an inflection point in the economy. And that's when, of course, we find out, as we talked about yesterday, that U.S. consumers hit a breaking point. Well, we're not far off before the U.S. economy hits its own breaking point. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.